Greetings, fellow traders, and Happy New Year's! It's January 1st, 2017. Ready to get to work? Me too. New trading year starts in 2 days. Monday, of course, is a legal holiday. Markets are closed. That's where we're going to be in training and prep mode for the gang. And then Tuesday kicks off the new adventure. The last trading efforts that I endured, if you will, experienced was last Wednesday, actually. And it was with crude oil, which, quite frankly, crude oil was very muted, very choppy for the past couple of weeks. Low volume, low everything. Whereas stocks were historically low volume, but they made nice directional moves. And we'll talk more about that later. So here's crude oil. And here is the filter chart, trigger chart setup that I use. It's the various combinations work. There's no magic in the actual numbers. The numbers could be changed, and that would be perfectly fine. It would give slightly different signals at slightly different times, but over the course of 50 trades or 100 trades, the average results would be about the same. I understand that's a tough concept for most traders to grasp, because it's human nature to think that there is an apex or a peak or a best or an ideal or a premium of anything. All right, and so by that mode, our nature wants us to believe that somewhere out there is just the optimum setting for charts that is going to be even the slightest bit superior above all else. And the fact is that's not true. We could take whatever charts we use for whatever symbol we use, and we could tweak them around to different settings, which would give us slightly different results with the same process. And that really is the fact that ensures we can share information amongst other people, because if there was just one chart setting that worked and nothing else did, it would be saturated and overwhelmed, especially in lower liquidity symbols like crude oil, like NASDAQ 100 futures, like Russell 2000 futures, like Dow futures, and mostly all of them. All right? So rejoice in the fact that you can tweak your charts and I can tweak my charts just a little bit differently, and we can come up with the same aggregate results over time. That's what ensures the ability that we can share systems, if you will, or trading approaches or methodologies, and never have them saturated by overwhelming mass of application, if you will. So anyway, back to the moral of the story. Minus 5 ticks, and then I think it was plus 15 ticks, right? 53.80 to 96, plus 16 ticks for a net gain of plus 11 ticks, and my day was done. That was it. A lot of traders, some members and non-members, are asking me, so what are your plans for 2017? What's new for 2017? What are you doing in 2017? And the answer is a lot less trading. I'm going to do a lot less trading for a lot more money. Thinking back to when I got started, 1999, 2000, 2001, 2, it seems like it was a lifetime ago. And it was for the markets. They were driven by completely different factors with totally different participants in dramatically different ways. Back then there was tons of volume, tons of stupid money, taxi cab drivers and janitors who were day traders and so on, and it was not uncommon for relatively new traders to come in and make, large amounts of money quickly. And for veteran traders, they would make insane amounts of money. There were guys that would make 5, 6, or 7 figures in a day, in a session. That was common for veteran traders for a little while. That's not common now. Actually, it never happens anymore on a consistent basis. Now, trading is more of what it is for the most part. Just a daily grind that turns into a weekly grind, that turns into a monthly grind, that turns into an income. That's a business opportunity. The glory days that you see on TV, the Wolf of Wall Street and all that stuff, that's crap. That's not our reality. That's just Hollywood fantasy. The reality is we're grinding out paychecks to make a 5-figure, 6-figure, 7-figure annual account. Annual income depending on account size. So in my case, with the current market reality that there's scant opportunities compared to what there was in the past, but plenty of opportunity what there is today if handled right. It's a scalper's world. That's really what the markets are all about. Going in and taking tiny price moves, even modest or medium price moves occasionally, when the edge, odds of probability favor us. That's trading. And then shutting it down. Do you know what isn't successful trading? What has nothing to do with successful trading? Sitting in front of the screens all day, every day, taking every signal that comes along, playing the, well, let's see how much we make today game. That's gone. That's a different era. If it ever succeeded long term, it certainly doesn't now. And so I'll be honest with you, I really am not sure what symbol I'm going to be trading at the end of 2017 or in the middle of 2017. I'll tell you, I'm going to pick up where I left off with crude oil as my primary driver, with the S&P as a secondary interest to me. But there are other good symbols too. Russell 2000, it's illiquid, but it trades well. NASDAQ 100, relatively illiquid, but it trades well. All of the currency futures, relatively illiquid, but they trade well. For one person who wants to flip a contract or two, all of those things are fine. Here's an example of Russell 2000 futures trade signals coming from same day, December 30th, which was the Friday, of course. And here were it was here. I'm sorry. We're looking at the day before, Thursday, December 29th, actually. And here's the filter chart. And here's the trigger chart that, in my opinion, are appropriate for this symbol. But like I said, it could be, you could change this number greatly. You could change this number greatly, faster, slower settings, and accomplish the same thing. Here were the sell signals at this point in time, right around the opening bell, and here are the sell signals. And this is a classic breakout slash pullback to the breakout, breakout slash pullback to the breakout, which stock index futures do consistently. And crude oil futures more than they used to. Crude oil futures historically, and we're talking prior to 2015 really, would break out and run because that's what they did. But with a lack of with lower liquidity and with more algos, all futures markets and quite frankly all financial markets are much more back choppy, much more backfill, much more pullback than they ever were. So whenever you have price trying to leave some point of congestion and move into expansion, it's constantly being pulled back to retest, and fundamentally what that is, market participants slash algos trying to take out all the stops, trying to eat the liquidity there, create losses for other traders, wins, profits for themselves before price moves on to the next discovery point, right? So in other words, price doesn't go as directionally as it did in the past without much more pullback, sideways chop than it ever had in the past. And so this is how we adapt. Anyway, sell signal, it went more than $200 in favor. I think the Russell 2000 futures now are $50 per index point rather than $100 like they used to be, which makes them $5 ticks instead of $10 ticks. 10 ticks to a point, $5 per tick, $50 per point. So if they move 4 index points, you're talking $200 on the scalp. Okay? If you're using a $50 or an $80 initial stop and you're targeting $200 scalps, and you're very patient and you wait for your filter chart to be in bearish mode, and then all you look for are sell signals while it's in bearish mode, and you sit there and you sit there until a sell signal comes along and you take it, and it goes $200 or thereabouts in favor, and you take that off, and that's your day per contract. Okay, and then the next day and the next day and the next day, they are what they are. Here's NASDAQ 100, same situation. Price is what it was. Here we have, sell signal mode, and then once again, sell signal mode, and that's price moving directionally from contraction to expansion. And here is the sell signal. It's a breakout, and then there's a pullback, obligatory, happens all the time. And then here's the second signal from the zone, which is a pullback, and then continuation of the break, and down it goes. And price moves more than $200 in favor. Take that scalp off. Done for the day. Reward yourself. Go out and live life. You made $200 per contract. If you're trading 2 contracts, it was a $400 morning. If you're trading 10, it was a $2,000 morning. You can fill 10 contracts in NASDAQ 100 quite easily. Now you can fill 5 for sure, and $200 times 5 contracts is $1,000. And there you go. You worked for an hour. You made $1,000. You have the rest of the day to live the rest of your life any way you want to. That's trading, circa 2007. The reality of trading is not about big gains, big profits, big trades. It's about putting together consistency, small or modest gains on increasingly larger trade size. And so, for example, everyone, loves compound math because math is an exact science. I've said this a million times. Math is the purest science. It's black and white. I mean, there's no debating whether numbers are or they are not. The numbers are what they are, and here are the numbers. If you start trading month 1, whenever that is, in our case, it's January 2017. If you start with 1 contract of anything, and you add a second contract when applicable, and in my case, I sometimes add a second contract when the first contract trade has moved in favor far enough so I can take the risk off that trade, and I get a second signal. I get a continuation signal, and then I'll be long or short 2 contracts with the same risk. Okay, so if in month 1, that's all you do. You're just flipping 1 contract at a time, and sometimes 2, and you can average just $100 a day. That's an average. I'm not saying you're going to make $100 stop, make $100 stop, make $100 stop 20 days consecutively. We all know that doesn't happen. But in your wins and losses, if you have a day that's plus $220, next day is plus $280, next day is plus $300, then the next day is minus 140 or minus 200, and then the next day is plus 100. At the end of that week, you've made, $400 or $500, whatever the case is. Okay, so if you can just find a way to average $500 weekly per whatever futures contract you trade, it doesn't matter what they are. Contracts and symbols are widgets. It's the application. We don't trade crude oil. We don't trade the Russell. We don't trade NASDAQ 100. We don't trade the euro. We trade dollars. That's what we're doing. We're trading money, and we're just using the symbol as the assigned widget. No different than if you're in a casino and you're playing one hand of poker or another hand of poker, or you're rolling dice or something else. All you're doing is working money with the odds of probability hopefully in your favor, using whatever means to make that happen. Trading's the same way. All right? If you do that for 1 month and you accomplish this simple task of $500 weekly gain, $500 a week, that's not anything like what is portrayed in the movies, like Wall Street and Wolf of Wall Street and all that rubbish. Okay, but you just make $500 a week, average $100 a day, and stop and go do something else, and don't worry, and don't churn your account and so on and so forth. At the end of the month, you would have put $2,000 in your account. Can we agree that that math is true? All right, I'm not saying you're going to, and I'm not saying you aren't, but I'm saying if you can, if you find a way to do that, just $500 a week. And that includes if by Tuesday, if you trade Monday and Tuesday, and you're up $600 for the week, and you stop trading, and there's no further chance for loss, and then you begin again the next week, and if your total goal is to reach $500 or greater per week and stop, you can do that too. If you accomplish that in any way, shape, or form, then you've added $2,000 per contract risk to your account. And so month 2, the second month, you can start out not turning 1 contract initially, but now 2. And if you work the 2 to 4 contract thing, by the same token, $500 a week per contract, but now you have 2, then you're going to put $4,000 in your account, $2,000 per contract. Same as you did before. You're just doubling your trade size. Nothing has changed. You're still running the same execution, same entries, same exits, same scalpy mode, same 5 or 10 ticks, occasionally 20 ticks. You're just doing it with double the size. And then the next month you double that size. And then the next month you double that. And the next month you double that. And the 6th month you double that. And guess what? That math would allow you to put $64,000 in your trading account by turning 32 contracts of whatever will let you fill 32 contracts per trade. But you've not changed a thing. You're still seeking $500 in an entire week per contract. Now your biggest problem is, what future symbol will allow me to flip 32 or 64 contracts at a time? Quite frankly, right now, that's only the S&P. You could not do that consistently in crude oil. You wouldn't get filled. You absolutely wouldn't do that. You would be the market in the Russell. If you tried turning 30 contracts, you would be the market. You would push things 10 ticks or more. NASDAQ 100 would be FE. Euro futures would be FE. S&P would let you do that. And I'm not saying this is what we're striving for. I'm not saying by any means that this is going to go on to infinity. I'm simply saying the power of compound math on tiny gains. If all you can do is make $100 a day, or let's say by Wednesday of a week you've made $550 and you shut it down, most people who think about trading be like, what in the hell? All you did was make $500. That's it. Why are you stopping now? Why aren't you trading Thursday and Friday? Or, okay, all you made was $120 today. Why aren't you trading further? There's more opportunity. That's not what we're working for. We are working for achieving $500 per contract weekly, safely kept in an account. Not give and take, put it in an account, and then focus on doing that same thing the next week. Focus on being picky with our entries, being defensive with our stops and losses, accepting small gains, grinding out modest, consistent gains, and then adding size. That is trading. That's the magic of trading, the power of compound math. Not hitting home run trades on small size, not taking 20, 30 trades a day for dimes and nickels to make dollars, nothing like that. Being patient, being picky, waiting for the odds of probability to be on our side, being incredibly patient, sitting on our hands. When the time comes, act aggressively and decisively, exit aggressively for acceptable gains, and then stop and keep them and repeat the process the next day. And when we're profitable enough, stop and then repeat the process the next week and the next week and the next month, and let the law of large numbers take over. This is perfect science here. Nobody can dispute this is true, because this is fact. This is what will happen if we simply accomplish this. This is the variable. These are the constants. All we have to do is make $500 a week and keep it. However it is that we make that happen, if we make that happen, when we make that happen, and we apply this to that, these are guaranteed results. The variable is upon us. Making this happen is the variable within each of us, and this is what I'm going to do. Hope this helps. Looking forward to trading with you inside, and as always, best trading wishes.